we're going to go into recession and therefore we're going to see a collapse. And really what we're looking at is stuff that was already priced in again. So if we look at like imports and exports, we're seeing world trade falling. So here's the Eurozone imports from non-Eurozone countries, right? Collapsed. We've seen that everywhere. We know this information. This information was essentially that fall in the ISM. There's nothing new to know here. Yes, economic growth is incredibly slow right now. Yes, many countries are in a recession. Yes, some will avoid a recession. I do think the US is in a recession now, and it's a mild one. But that's what we see from this stuff. Also, if there's a recession, you see jobs falling. So here's job openings. Now, job openings are coming off sharply, and they will continue to come off until they get back to some sort of trend.
The U.S. Federal Reserve held interest rates steady on Wednesday, but stiffened a hawkish monetary policy stance that its officials increasingly believe can succeed in lowering inflation without wrecking the economy or leading to large job losses. The Fed's benchmark overnight interest rate may still be lifted one more time this year to a peak 5.5% to 5.75% range, according to updated quarterly projections released by the U.S. Central Bank, and rates kept significantly tighter through 2024 than previously expected. People hate inflation. Hate it, Fed Chair Jerome Powell said in a press conference after the end of a two-day policy meeting at which central bank officials held the benchmark overnight interest rate in the current 5.25%-5.5% range, but sketched a stricter policy path moving forward in an inflation fight they now see lasting into 2026. But a solid economy with still strong job growth, Powell said, will allow the central bank to keep that additional pressure on financial conditions through 2025 with much less of a cost to the economy and labor market than in previous U.S. inflation battles. Raoul Powell explores the labor market, unemployment, and how it is related to the Fed's hiking cycle. Let us now get into it in full. Please don't forget to hit that like button, subscribe, and drop your comments as you watch. Enjoy.
Everyone frets over this bloody stuff every month. And really, the forward-looking indicators have been calling it all along. It's going lower. It just takes time. These things are lagged, if you remember. Wages lag ISM, and they will eventually keep falling, and then we'll start getting negative prints, and people will suddenly wake up and smell the coffee, much like we've seen with the unemployment rate. It's like, oh, it's ticking up now. So it does come, but it takes time. And by the time non-farm payrolls are negative, and inflation is below 2%, well, the market's well looked through this and it's looking for the recovery. But it also means that the cowbell, the monetary stimulus, the printing, and even the ability in an election year to add fiscal stimulus grows. And I think they want that. I think they want the excuse to stimulate. And I'll come on to why, but for the election side of the cycle, of course they do. They always do. Politicians just want to hit the print button, give you money, vote for me. That's the way the world works, sadly. So the unemployment rate. So this is an inverted unemployment rate. So as this goes down, unemployment rate rises. Our GMI unemployment index leads by 3 months. It's suggesting unemployment is going to rise about 1% from the low. So we're starting to see that happening. So unemployment should start ticking up. Now, if unemployment's rising, and inflation is falling, ding, 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 more cowbell. More cowbell, yield curve, interest rates start falling. Remember the financial conditions index? The dollar starts weakening. And what we get at that point is the financial conditions index showing further loosening. And that drives the next leg of a bull market. So I think the market continues into the end of this year. Then it might have a soft patch as the financial conditions index, which is forward-looking, slows stuff down, and then from the cowbell, we'll see it going forwards. I'm not focused on the volatility part. I'm in this cycle for the full cycle, which I think goes into 2025, maybe even to 2026. So it's kind of for me as you strap in and ride the trend, and I'll talk about what assets in a bit. Okay, the other thing to know about unemployment rate is every time it rises by 0.5% from the low, the Fed cuts. Every single time since about 1950. Now, you might say, but unemployment is crazy low right now. And that's true, but it doesn't necessarily lead to wage rises or ongoing wage rises. Japan has had very low unemployment. In fact, for the last 10 years, got a 10-year older population. It's had unemployment at 3.5% or lower, basically, barring a couple of recessions, for extended periods of time. And that's because as their older population leaves the workforce, the younger population has jobs, but they have to compete against friendshoring, offshoring, and technology. So wages over time still never really rise. So yes, we get some wage rises pushed through because of what happened last year, but generally speaking, we don't see any evidence of sticky wages or wage rises or some wage price spiral, any of that sort. It's just not evident in any of the data.
Indeed, monetary policy is expected to remain slightly restrictive into 2026, while the economy continues to largely grow at its estimated trend level of around 1.8%. Even as inflation declines for the rest of 2023 and in coming years, the Fed anticipates only modest initial reductions to its policy rate. That means the expected half percentage point of rate cuts in 2024 would have the net effect of raising the inflation-adjusted real rate. Raoul continues with his outlook, especially when it has to do with the projection that the U.S. is not really in a recession, which in his opinion is intact and mild. Let us now get back into the video.
So now we've established that we think that the economy is currently in recession. We think it was priced last year by asset markets, and therefore they are looking forwards. Our financial conditions index, which is 9 months in the future, has been going up for a significant period of time. That calls exact timing of the low in the ISM. The markets exactly followed suit. The liquidity cycle is driving. Here we are with a slow economy. Here we are about to see unemployment rising, non-farm payrolls falling, and inflation falling, and an ongoing deflation in core CPI. That is exactly the set of circumstances why I think the Fed was so late with the rate cycle this time around, because they want these things to undershoot, because what they need to do is debase the currency to pay the debts. And this is something I've talked about in the Everything Code. So let's not get ahead of ourselves. First, liquidity. Liquidity matters. And our GMI Weekly Global Liquidity Index actually lags our Financial Conditions Index by 5 months. So that's very useful. It tells us liquidity is going to keep rising. It's going to keep rising well into 2024, where we might get this little air pocket. But don't concern yourselves with the wiggles. They don't mean a lot. Overall, directionally, we should be headed much higher in the global liquidity cycle. So that's what I'm expecting. So therefore, I cannot be a bear, because if there's excess liquidity, you're debasing the currency, so optically asset prices rise. And the assets I'm long are the secular trending assets. So those are the ones that naturally go up, like the NASDAQ and cryptocurrencies. Those ones are in a natural secular cycle, so they will continue to go up. Now, some of you might go, well, NVIDIA, that's so expensive, it's overvalued, blah, blah, blah. I don't care. It's liquidity that drives everything. We only need to worry about that stuff at the end of the next cycle, when inflation is coming back and rates are going back up. We're the opposite of that right now. We've got a lovely 18-month period of rate cuts, stimulus, and all of the good stuff. That's what you should be focused on. You shouldn't be focused on these other red herrings. They only matter when the cycle rolls over, and that's not for a period of time. So here's another longer lead. This is our GMI Weekly Global Liquidity Index versus ISM. So ISM has a 15-month lead because of the cyclicality of the global economy that we've talked about before due to the rate refi cycle. Well, that suggests that all of 2024 liquidity is going to be rising. So we've got a great year to come in 2024, all things being equal.
As of June, Fed officials had expected to cut rates by a full percentage point next year. While Powell said the Fed was in a position to proceed carefully with future policy moves, he also made clear the jury was, to some degree, still out on the central bank's fight to contain the worst outbreak of inflation in 40 years. We want to see convincing evidence, really, that we have reached the appropriate level of interest rates to return inflation to the Fed's 2% target, a judgment its policymakers have not yet made, Powell told reporters. Inflation by some measures remains more than double the Fed's desired level, though Powell said the pace appeared to be in decline across several key parts of the economy. Bond yields jumped after the release of the latest Fed projections and policy statement, with the 2-year Treasury note at a roughly 17-year high near 5.2%. Major U.S. stock indices fell. While Powell's inflation language remained strict, the tone did shift to accommodate what appears to be a growing sense among U.S. central bankers that the sought-after soft landing may be developing. Powell would not call it the Fed's baseline yet, but the path had likely widened. "I do think it's possible," he said, a comment underlined by projections showing Fed policymakers at the median see inflation continuing to fall even with gross domestic product continuing to grow and the unemployment rate never rising above 4.1%, an outcome that would fly in the face of U.S. history and the predictions of several top economists. Even Fed staff had until recently penciled in an expected recession this year, the usual outcome of successful inflation battles that drive out spending and investment and push up joblessness. The median GDP forecast among policymakers for 2023 is now 2.1%, 5 times where it began the year. With the federal funds rate falling to 5.1% by the end of 2024 and 3.9% by the end of 2025, the central bank's main measure of inflation is projected to drop to 3.3% by the end of this year, to 2.5% next year, and to 2.2% by the end of 2025. The Fed expects to get inflation back to its 2% target in 2026, which is later than some officials had thought possible. Ahead of this week's Fed meeting, investors had been banking on significant rate cuts next year, an expectation clouded by the projections that show 10 of 19 officials see the policy rate remaining above 5% through next year. That means companies and households will face even tighter credit conditions and higher borrowing costs than they have already absorbed during the Fed's aggressive 2-year battle to contain inflation. What do you think of Raoul Powell's view on the recession projections? Let us know in the comment section below. Don't forget to hit the like button, subscribe, and turn on notifications. Thanks for watching.